Do you want to know how to get richer every year? Well, the secret lies not in a sudden windfall or winning the lottery, but in understanding and leveraging the power of compounding assets. Compounding assets, you ask? Yes, these are investment vehicles that not only generate returns, but also reinvest these returns to generate their own earnings. It's like a snowball effect, where your wealth grows bigger and faster over time. Think of it as planting a seed today. With time, the seed grows into a tree, bearing fruits year after year. Similarly, your investment today becomes your wealth tree of tomorrow, growing and bearing financial fruits as years pass by. Smart investments are crucial in this process. They are your seeds that will grow into wealth-bearing trees. So it's not about how much you invest, but where and how you invest that counts. In the next few minutes, we will explore 7 compounding assets that can help you become richer every year. The first compounding asset we will discuss is stocks. Stocks represent ownership in a company. When you purchase a stock, you're buying a piece of that company, making you a shareholder. The value of your stock goes up and down with the company's performance. How do stocks compound? Well, let's imagine you own a stock that pays dividends. These dividends can be reinvested to buy more stocks, increasing your ownership in the company. As the company profits grow over time, so do your dividends and hence your reinvestments. This cycle of earning, reinvesting and earning more is the magic of compounding. Now, the stock market can be volatile and prices may fluctuate. But here's the key: long-term investing. Historically, over the long run, the stock market has trended upwards. So despite short-term volatility, a well-diversified stock portfolio can offer compounding returns. With a smart approach and patience, stocks can become a powerful compounding asset. The second compounding asset on our list is bonds. Now, bonds are essentially an IOU issued by entities like governments or corporations looking to raise funds. When you purchase a bond, you're loaning your money to that entity for a fixed period of time. In return, the issuer promises to repay the loan on a specific date, known as the maturity date. But what makes bonds a compounding asset? Well, it's the interest. Bond issuers also promise to pay you interest, typically semi-annually or annually. This income can be reinvested to purchase more bonds, which in turn generate their own interest. This is the power of compounding at work. Bonds are considered a lower risk investment compared to stocks. While returns may be modest, they tend to be more predictable and steady. This makes them a great choice for those seeking a more conservative approach to growing their wealth. Bonds offer a safer route to earning compounding returns, making them a valuable asset in any investment portfolio. Next up, we have real estate. Often overlooked, real estate holds immense potential as a compounding asset. This is due to 2 key factors: rental income and property appreciation. Let's start with rental income. When you purchase a piece of property and rent it out, you're not just sitting on a static asset. You're generating a steady flow of income that can be reinvested, allowing your wealth to grow over time. Now let's talk about property appreciation. Over time, the value of your property can increase, thanks to factors like improvements to the property, economic growth, and demand in the housing market. This appreciation in value can significantly boost your net worth, especially when combined with rental income. So don't underestimate the power of bricks and mortar. With the right strategy, real estate can provide you with a steady income stream and potential appreciation, making it a strong compounding asset. Our fourth compounding asset is mutual funds. Now, you might wonder, what exactly are mutual funds? To put it simply, mutual funds are investment vehicles managed by professionals. They pool the resources of multiple investors to buy a diverse portfolio of stocks, bonds, or other assets. This means that by investing in a mutual fund, you get to own a fraction of each asset in the fund's portfolio. But how do they work? When you invest in a mutual fund, you buy shares of the fund. The price of each share, known as the net asset value, fluctuates based on the total value of the fund's underlying assets. This allows your investment to grow as the value of these assets increases. The beauty of mutual funds lies in the diversity they offer. By spreading your investment across a range of assets, they help mitigate the risk associated with investing in a single asset. This diversity, coupled with the potential for compounding returns, makes mutual funds a compelling investment option. Mutual funds provide a diverse investment option with potential for compounding returns. The fifth compounding asset we will discuss is ETFs. ETFs, or exchange-traded funds, are investment funds traded on stock exchanges, much like individual stocks. They are designed to track the performance of specific indexes, sectors, commodities, or assets. An ETF pools the money of numerous investors to invest in a basket of assets. This allows investors to diversify their portfolios without having to buy each individual asset. The beauty of ETFs lies in their ability to compound returns. As the investments within the ETF generate earnings, these earnings are reinvested back into the fund, leading to an increase in the value of the ETF over time. Moreover, ETFs offer transparency and liquidity. You can see what assets the ETF holds at any given time, and you can buy or sell ETF shares during trading hours just like stocks. In essence, ETFs leverage the power of compounding, diversification, and liquidity, making them a compelling compounding asset. ETFs offer an easily accessible way to earn compounding returns, making them a great addition to any investment portfolio. The sixth compounding asset on our list is dividend reinvestment plans. Also known as DRIPs, these are schemes offered by corporations that allow investors to reinvest their cash dividends into additional shares or fractional shares of the underlying stock on the dividend payment date. Rather than receiving your dividends in cash, they are reinvested to purchase more shares of the company. This process is automatic and occurs every time a dividend is issued. Now, you might wonder, why would anyone want to do this? Well, the beauty of DRIPs lies in the power of compounding. Let's break it down. Suppose you own shares in a company that pays dividends. Those dividends are automatically used to buy more shares, and then those new shares generate dividends of their own. These new dividends are also reinvested, leading to the purchase of even more shares. This cycle continues, with the number of shares you own and the dividends you receive both growing over time. The magic of DRIPs is that they allow your investment to grow exponentially. The more shares you hold, the more dividends you receive, and the more dividends you receive, the more shares you can buy. It's a virtuous cycle of growth. Moreover, many companies offer these plans with no commission or transaction fees, making them an attractive option for long-term investors. Plus, some even offer shares at a discount to the current market price as part of their DRIPs. However, it's worth noting that while DRIPs can be a powerful tool for wealth accumulation, they are not without risks. The value of your investment can go down as well as up, and you should always do your due diligence before investing. But if you're looking for a way to harness the power of compounding and potentially grow your wealth over the long term, DRIPs could be a great addition to your investment strategy. Dividend reinvestment plans offer a simple and automatic way to reinvest your dividends, leading to compounding growth over time. The final compounding asset we will discuss are retirement accounts. Just like a fine wine, these accounts get better with age, thanks to the power of compounding. But what makes retirement accounts such as 401(k)s and individual retirement accounts, or IRAs, a powerful compounding asset? It's all about the tax advantages they offer. Imagine this. You're planting a money tree, but instead of sunlight and water, this tree thrives on your investments and time. Now, suppose someone came by every so often to pluck a few leaves off your tree. That's the tax man. With regular investment accounts, you pay taxes on your earnings, which can slow down the growth of your money tree. Retirement accounts, however, offer you a shield against this. They come with tax benefits that can protect your earnings, allowing your money tree to grow unhindered. This is where the magic of compounding comes into play. Your earnings are reinvested, and then those earnings earn more, creating a snowball effect. Over time, this can lead to substantial growth in your investment. 401(k)s and IRAs are the most common types of retirement accounts. 401(k)s are usually offered by employers and often come with matching contributions, which is essentially free money. IRAs, on the other hand, are opened by individuals and they offer more investment options. Both these types of accounts come in two flavors: traditional and Roth. Traditional accounts give you a tax break now, but you'll pay taxes when you withdraw the money in retirement. Roth accounts, on the other hand, are taxed now, but withdrawals in retirement are tax-free. The beauty of these accounts is that you can choose the one that best fits your financial situation and retirement goals. But remember, the sooner you start investing, the more time your money has to grow. Investing in retirement accounts can provide you with tax advantages and compounding growth, making it an important asset to consider. We've now covered 7 compounding assets that can make you richer every year. We started with stocks, the equity shares of companies, and bonds, essentially loans to entities promising a return. We moved on to real estate, a tangible asset with potential for both income and appreciation. Then we delved into mutual funds, a pool of investments managed by professionals. We also touched on ETFs or exchange-traded funds, offering broad market exposure. We explored the beauty of dividend reinvestment plans, turning earnings back into more shares. Finally, we discussed retirement accounts, tax-advantaged vessels for long-term growth. Each of these assets has its own unique benefits and risks. The magic lies in diversifying your portfolio across these different asset classes, balancing risk and reward. This blend of investments is the secret sauce to building and maintaining wealth. Remember, the key to wealth growth is patience, diversification, and understanding the power of compounding assets. Start today and watch your wealth grow.